Welcome to the Broken Pie Chart Podcast, episode 252. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, CEO of ZEGA Financial, Jay Pestrichelli. Jay, Merry Christmas, Happy Holidays. Last one before the big holiday week.
Yeah, excited. We gotta. By the time people hear this, right? Monday off, short week. I get a lot done during this week. I don't know about you, Derek, right? But that kind of shortened week market. If the market doesn't pull a 2018 on us, it could actually be a very productive week. So looking forward to it.
Yes, as am I. Now, of course,
You
we did have a
2018,
little bit of a
right? Was that an obscure reference, the 2018 nonsense?
Well, we should. All right. So for anyone who's not immediately thinking, oh, I know what that is, 2018, the markets into the holiday sold off not quite 20%. It was almost an official bear market. And it was sharp. It was over really 2 weeks, and it traded down. I think we traded on Christmas Eve, the 24th that year, and it was down, and that was sort of the Christmas Eve bottom.
Yeah, it was like down 3.5%, 3% the day before, 3.5% the day before. It was just like every day down, like, multiples. And it was like, ugh, it was just the lack of liquidity and interest and everything like that. Because 2018 started out a pretty strong year. First 3 quarters were great. And then it just all kind of went down. We should maybe get a sound effect for 2018.
Something like that. Well, what's this punchy? A lot of people are blaming. So let me set this up, and then we can have some discussion on it. Zero DTE options again. Now, Wednesday, we had a sell-off, and if you were following the markets, the chart was sort of up and to the right on the intraday chart, and then you had this sell-off, and we actually sold off around greater than 1%. I think it was down 1.5% at one point.
Yeah, 1.3, 1.4. Come on, yeah, it wasn't awful.
Yeah, it wasn't awful. But of course, the several, both on Twitter and then on CNBC, I think some other outlets, blame zero DTE options. And what they blamed was they said that people were long a lot of puts and they're, cheap out of the money puts. And when the market started to come down, that causes the market makers to sell stock and sort of exacerbate the sell-off, but not so fast as the CBOE. Contrary, and I'm reading this, this is a Bloomberg article titled Zero-Day Options Shouldn't Be Blamed for Sell-Off, CBOE says. And it says, contrary to what some Wall Street analysts are saying, a surge in trading of zero DTE expiry options shouldn't be blamed for Wednesday's sell-off, says the CBOE. And I'm not going to read the whole thing, but skipping down, they say, a number of analysts cited that so-called gamma hedging for acceleration slide. And that essentially means that when there are options on one side or another, and let's say the market's coming down and the negative deltas are increasing, the market makers have to sell more stock. And that's what the people who are blaming zero DTE options are really blaming. And we can expand on this, Jay, once I kind of finish telling you what the CBOE did. And the CBOE says, but market makers were mostly long gamma throughout the sell-off. CBOE data shows, meaning they were essentially going against the prevailing trend and actually buying stocks as they fell. Quote, this means, if anything, their hedging activity would have been a stabilizer rather than a primary driver of the sell-off, said Mandy Zhu, head of derivatives market intelligence at CBOE. All the headlines are once again much to do about nothing, end quote. Let's discuss, Jay. What are your thoughts here?
My thoughts are like, hey, after up 9 days in a row, and then you have a 1.5% sell-off, all of a sudden you gotta, blame the usual suspect here, which is zero-day options. I just find it ridiculous that people can take that blame. Like options, gosh, like I think about that dynamic. Like that is such the tail wagging the dog mentality, where the options market is impacting, because of a small group that is, actively trading the options is actually impacting the overall market. Hey, how about it's just like what you always say? There were more sellers than buyers that day. And
Love it.
So people took some profits. Like this is not unusual. And I will tell you this, there's a lot of people who are waiting to take the market down because of, look, we're approaching a technical top. approaching the 2020, I think it was 2021. It might have been like January, the first day of January 2022, where we had that the previous all-time high. Yeah, to have a down move as you're approaching a technical top is very, very normal. But to all of a sudden blame zero-day options, it seems lazy, Derek. I don't like it.
Well, yeah, and the CBOE has been pretty transparent about some of the data here. I'll just again, I'm not going to read this whole thing. They said options activity in the index that day was concentrated around puts at 47.55 to 47.65, and they were ones expiring Wednesday. But I think they said that buying only exceeded selling by only about 1,000 contracts, the exchange data shows. So it looks like, and nobody can see this graph, but it's sort of even, the buying and selling. So like the CBOE has this data. They show it. So I'm in agreement with you. I think it's lazy to blame those for any little downturn in the market. And
yeah,
I think it's lazy.
Lazy. I don't like it. Let's move on to people that actually know what they're talking about. I mean, actually, can I just say this comment, Derek? Like, we have a lot of products out there that people write articles about. I mean, how often do they actually get it right? Like, what would you say? 1 out of 20?
I mean, I saw one today. I won't even say what it was covering or anything, because then we have other disclaimers and all sorts of stuff. But I actually messaged you and I said, did an AI bot write this? It was so bad. I mean, it just looked like they put no effort into writing the article.
Yeah. No. So it's just one of those things. Use your own judgment here, and look, journalists get paid to post interesting articles and get clicks, and the more clicks they get, just like as we've talked about, when things are fearful, that's when the TVs get the better rankings. Like, it's just one of those things that ratings, I should say. It's just one of those things that you got to just look at it and be like, that doesn't make any sense. Or just use your own judgment here. Don't believe everything you read. Hey, once again, Derek, good advice. Don't believe everything on the internet.
Except stuff that I write and you write and we publish.
Well,
believe all of that.
Yeah.
Well,
including this podcast.
Yeah, there you go. I will say that we've used the term fragility in the markets, and I think that's something you picked up. God, Jay, it was probably a CBOE conference, the risk conference you went to several years ago. Thinking back, fragility, and it's just the idea that markets have a propensity these days to sort of have these little air pockets. Is that a good way of sort of framing that?
Yeah, and like you're not sure when something it's not bearish. It's just something kind of breaks, right? Like like what happens, like the breakdown we saw in the minor banking crisis we had in March. Like all of a sudden, like when bonds exceed, I went right to bonds. Sorry, when bonds kind of hit a level that nobody thought, stuff started to break. Like that's the fragility. Like some things are. We like things to operate in conjunction. It's like a little environment in a terrarium, and it's got its own ecosystem. And one of those pieces, doesn't behave that the other pieces we're counting on, then there is this domino effect that things break. So the fragility concept is that it's not that things can be bad, because there's plenty of people that can make money when things are bad. The fragility concept is that things are breaking and getting disjointed and have to have a reset on their levels.
The other thing I've seen in that article and other quoted elsewhere is some Wall Street strategists are predicting a Volmageddon 2.0. And Volmageddon 1 was dealt with. There were exchange traded note products where they were short VIX options or VIX Futures. I think in the case of the one I'm thinking about, it was VIX Futures. And basically that fund sort of blew up because if the VIX went up by enough, the cost to cover the contract would wipe out the fund. And in that case, I mean, you essentially have, it's kind of like selling naked calls. Is you have unlimited risk, and that sort of blew up. That was Volmageddon 1. So I don't know. I think Volmageddon 2, caused by zero DTE options, I don't know exactly what they're saying is going to happen. I'm not quite sure. And I think I'll say it again. It's lazy. It's lazy to say it.
Yeah, it's by the way, talking about fragility, right? The impact of, and there were some of those ETNs, exchange traded notes, that had to shut down after that day. Like, it was pretty bad, right? And for those, and the impact of the rest of the market was meh. It was a little bit of a technical blip. It didn't break anything in the in the bond market or the equity markets. The options market felt the sting, but really didn't impact too much more. It's one of the things, if I could come up on that, the fund actually caused its own demise. I don't know if you remember this, right? So they were short VIX futures because it was an inverse futures product, right? That was kind of harvesting contango in options futures, which we
I
don't
love it.
have to go into too much. That was, I know. We could do a whole thing on contango, but essentially it just means that the farther out prices cost more than current prices in VIX futures because there's always upside risk. So, and eventually they go down, and it just took advantage of the fact that VIX futures eventually moved down towards the spot VIX. And we've talked about that before. But my point of this one is that the fund had so many redemptions because the market thought the fund might go out of business, right? So at the end of that day, the fund saw the redeems come in, and in the last hour, redeems is when a fund essentially is losing money and they have to close out their positions. Well, they short squeezed themselves. They had to go rebuy the futures contracts, and they themselves, by buying the futures contracts that they were short, pushed up the price of the futures contract they were buying, and they essentially squeezed themselves because of the fear that they might have to shut down. Well, it ended up turning out that they absolutely did shut down, and they were fine until the after hours, right? I think it was the trades that were happening at 4:30 after the regular markets had closed that actually caused that fund to have to shut down. So again, just an interesting market dynamics. It's a good example of fragility there too, where something gets really out of whack, and there's always a little a little damage off to the side and caused a reset. Not every short futures VIX fund went under, but a bunch did.
I do remember that day too, because we were sort of messaging back and forth, and my comment was the indicated price on this should be like zero. How is it still this? I was like, this is either the easiest money anybody could ever make, because you could have bought out of the money put options very, very cheap. But when I mean puts, I mean the fund essentially goes to zero. But I don't remember the price of the fund at the start of the day. But you could have bought ones for like 10 cents that essentially were a no brainer. I'm like, how is nobody doing this? And I'm like, I could be missing something, or this is the easiest trade you could ever make. I never wound up doing it because it was only there for a little bit. But I'm like, no, this has no value. This fund is zero. It's gone. It's gone based upon the positions. So anyway, maybe we'll if we ever do write that next book, Jay, we'll put that in there as some of our examples of crazy options days.
Look, it has to. You're talking about selling volatility, right? Volatility stuff. You got to include that as squeezes matter.
They do. All right. I'm going to really transition us away from volatility for a second. Right. We'll come back to it. But there is a little bit of volatility, Jay, in the container shipping area. I know you make fun of me, as other people do, for watching container shipping prices. There was a spike.
Hold on. I think I've given you due credit from what you recognize in 2020, 2021 on that. Like, that's years ago.
This is true.
And it would be fair for you to not let me forget that I did tease you, but I have tried to rectify and make it and give you credit for it.
Well, you weren't the worst one.
No, I was not the worst one. Derek and I, our history goes back so far that Derek and I think we just talked about this today. There's something you did 20 years ago when we were working together that I still make fun of you for. So
that's right.
I think
as
in
you
all
should.
fairness,
you should.
Yeah, and you should make fun of me too. There you go.
All right. So let me get through this little segment here, and then we can talk about this. So the World Container Index and the World Container Index, that includes all the routes: Shanghai to LA, Shanghai to Rotterdam in the Netherlands, Shanghai, New York, all sorts of shipping. That really spiked up. I mean, 40 foot, so a 40-foot box. Think about if you ever see a rail car. That's kind of the box that they stack on the container ships. The price was, I don't know, about $1,300, maybe $1,350 or so, and it spiked to roughly $1,700. And Shanghai to the UK, I saw one report on CNBC that said container shipping went from under 2,000 to 10,000 per container box. And the reason why that is the Red Sea shipping lane, which is the Suez Canal. So if you think about if you're shipping something, let's say Singapore, and you were going to ship something to Europe, to Rotterdam, which is the Netherlands, you can go, there's a channel that's on the northeast corner of Africa, between Africa and Saudi Arabia and Yemen. Well, there's some issues there with some activity, I guess we could say, some dust ups in that area. And so ships are having to maybe go around the southern tip of Africa. And the difference is it's a 40% longer voyage to go to around the Cape of Good Hope of Africa compared to the Suez Canal. So that's kind of what's going on. This could be a short-term blip. But Jay, I bring this up. I didn't really want to talk about the ins and outs of shipping containers. Well, I guess I'd love to do that, but I know you wouldn't let me. But the point I bring this up, it's kind of like, hey, if you're like really bearish and you're just trying to come up with things to say, oh, this is the fly in the ointment. I think we used that term last week. This is something below the surface that could cause a little bit of inflation pressure if it were to last, Jay. And that's the reason why I bring it up.
Well, it's kind of what kicked us off, for the most recent inflation flare up that we're still kind of dealing with now. It was one of the first things that happened, right? Like we started seeing, just a difficulty of getting products to the, shipping from one to another. So yeah, I'm with you, Derek. I don't know if this is a big problem. I think the U.S. has dispatched, some naval some naval ships, and they're going to try to put an end to the little military activity that's going there. So we'll see.
Yeah, it's kind of interesting though how this in a world economy, definitely, if it cost you $1,500 to buy a 40-foot container box and now it cost you 10 grand, that is significant. And that's what happened, as you say, to kick off the inflation with the supply side. Something else, Jay, that you and I talked about, and we meant to talk about on the show, I think over the last 2 weeks, was sort of the oil supply. How much supply of oil is there? And Jay, I know you've looked at the drawdown and the SPR. Maybe kick us off on this. I mean, is this something maybe that could are people missing this? I mean, everyone seems to be very bearish on oil. Like this is another fly in the ointment. Like if energy prices were to spike, is this kind of one of those things too?
Well, the reason why I'm looking at it, right? So when you look at the strategic reserve, right, we call it the SPR, Strategic Petroleum Reserve, right? When you look at the, kind of the barrels that are there, the volume that's there, yeah, it's low, and I think it's been one of those things that when the U.S. starts to kind of backfill and refill the SPR, it could be bullish for oil. But it's interesting. I mean, I was gonna. This is a different topic, Derek. But I was gonna say, I don't really follow gasoline prices any longer because I've my main car that I drive now is electric, and you and I've had that discussion a little bit before. I'm saying that tongue in cheek for you, but I do see that prices are dropping there, and could that be something that reverses? Like this is one of those reasons. If you're looking for a reason for inflation to kind of bubble back up, oil, while it's not in the core, inflation number, it is in the headline number, can start to, if we start to, refill the SPR, it's something that could put pressure on it. I had thought on this topic that, maybe if we have a really bad winter in Europe, that, with the Ukraine crisis that's going on there, we'll start to see a spike in, whether it was gas or oil, because, you still have the conflict going on in Ukraine. You still got Russia kind of controlling the oils and their oil, and the European nations banning using that. And so if they need a lot, but asked a friend of mine who's a president of an international company that manufactures, and his thought was, Jay, no, like all the contracts that Europe needs in case it's a bad winter have all been kind of put into place. And so don't worry about the weather being the thing that spikes oil. Do you remember right when that conflict started, Derek, right? Oil spiked in fear that, oh my gosh, they won't have enough oil to heat homes, right? Or to have enough energy. Remember, they were turning off the electricity on national monuments, like all kinds of stuff to conserve energy. And I was just thinking, like, no one's talked about that in a year. Should it be something we're thinking about? My friend, who I would consider an expert on kind of international supply chains, told me, yeah, he thinks Europe's got a lot of that stuff kind of ironed out. Look, it's a data point of one, but it was interesting. And I'm not surprised, by the way, right? You take all year to take care of potential disaster coming. So, I think so. Back to why I brought up the oil thing. Like, I think that's another thing that if the U.S. starts, purchasing oil, and at some point they're going to have to kind of refill the SPR, then that might be slightly inflationary.
Maybe they'll refill it, but they're politicians. So if you want to get elected, you kind of want energy prices to be low. And, maybe that's in a non-election year, they would do it.
Who makes that decision, right? Is that the elected officials that are making that? I guess it's an appointed.
Well, I found a CNN article because I was curious. So why didn't we buy, when oil went negative, and not like, I don't know how fast you can do this, but why didn't they just load up on oil and fill it to its ultimate capacity? Like I don't think it's ever been really a capacity. I found a CNN article back in from June of 23, and they were fact checking. So I guess President Trump or ex-President Trump was saying, he had the idea to refill the SPR when oil was really low. And CNN said he proposed to buy 77 million barrels for the reserve in 2020 as oil prices cratered because of the pandemic. But, and I'm quoting from the CNN article here, but the Democratic-controlled Congress rejected the funding that would have been needed to pay for the purchase, describing it as a subsidy. So I guess you need congressional approval if you're spending money, the power of the purse. So anyway,
interesting. That's good.
Yeah.
That's good knowledge. I learned something today, Derek. There you go.
And this is so I found that. But yeah, at some point you'd figure you have to buy it. And look, I'm saying this sarcastically. Like, the government usually picks the wrong time to do things. So it wouldn't surprise me if they wind up refilling it at really high prices or
at $120 a barrel. Yeah, right.
Now we'll do it. Now we're ready. Now we need to refill it. We gotta buy it before it goes to 300. That type of deal.
Exxon will be psyched.
Yeah, but the other thing too on just oil is the rig counts are not at really highs. I didn't put this in our sheet this week to look at. But between the SPR and just oil supplies, it's not at, let's just say it's not making any highs, so I think it's just something to watch. And the contrarian thing would be maybe to buy some energy. I don't know what energy company is going to do. I'm not telling you to buy or sell those, but a contrarian thing right now would be, let me get long energy. So I don't know.
I will say this about this, right? When you look at that kind of the chart that you provided, it is stabilized. Right. So when you look at kind of the weekly, it's been fairly stable since, the end of May, June. Right. So you look at June to today, it's about the same amount as in the SPR. So they clearly have kind of stopped the, flooding of the market with, U.S., SPR oil. So it is stabilized. So maybe it's not a big deal. Like you said, maybe it's not. I liked how we watched it kind of go down, but at some point they'll refill. Maybe it'll be slow.
Maybe politically they don't need to do it right now because U.S. regular all formulations gas price, according to Federal Reserve Bank of St. Louis, reached 3.053, and that doesn't really mean anything to you or our audience, but consider it was $5 on June 13th of 2022. So you're at a level, nobody can see this chart but me, but you're at a level where we're starting, if it keeps going down, we're going to be below the 2021 May area. And really, it was below 3 going all the way back to 2014 until it broke out in 2021. So I don't know. Seems like, and I realize there are taxes, there are different formulations depending upon where you live. That's the other thing. I don't think people realize how much is embedded in the price per gallon is taxes. Like, isn't California like $1? Something like that. Something crazy like that.
Probably more. It's probably worth looking it up before I just guess, but I had always thought more.
I know where to find the list. I won't do it now because I do want to transition, Jay, to some other levels. And next week, the plan is for you and I to do our prediction show. We're going to see where we went wrong in 23, make some predictions for 24, as well as some other content. I just thought it was interesting. When you look at, this is from TKER, that is Sam Rowe. He had a screenshot on X, formerly Twitter. I guess you have to say X, formerly Twitter. You can just say X now, I guess. But it's the range of targets that's really interesting. So JP Morgan's year-end 2024 target is 4,200. Okay, so that's a negative year. Morgan Stanley's 4,500. And then you go Deutsche Bank, BMO is 5,100. Capital Economics is 5,500. Goldman's 4,700. Wells Fargo 4,625. I'm not going to read them all. So there's definitely a range of outcomes, but it sort of is interesting because I pulled up the consensus estimate, and I'm going to kind of lead the audience and us down this path. The consensus estimate for 2025 is 276. And you might say, well, why are you concerned about 2025 estimates, earnings estimates on the S&P 500 if you're talking about year-end 2024, so that's next year S&P 500 index targets? And the reason why I'm interested in 2025, because essentially, if you are making a prediction about what the market's going to be at the end of 24, you're sort of saying, I'm going to pick, if I know what my earnings estimate is for 25, then to get the level, I have to back into the multiple. And so I think Morgan Stanley's estimate is 266, and their year-end target is 4,500. So if you do the math and you say, well, if the forward estimate is 266 and the year-end is 4,500, they're saying it's going to be trading at a 17 multiple. But on that same 266, Jay, if it trades at a 20 multiple, well, that means the target is 5,320. You see where I'm going with this, where it's kind of like, this is why it's so hard. You got to pick the earnings, and then you got to pick what the market multiple is. Like, how much are pilling? Yeah.
Yeah, I mean, like you're talking about here, like, okay, to know where the market will end next year, 2024, you need to know what the market, what companies will make through 2025, right? So, like, think of, it's a year from now. We want the prediction because that's all what we care about. Like, what happens in 1 year from now, which I think you and I both sometimes go like, investing is longer than a year at a time, people, right?
Yeah.
Like, it's okay, but it's like we still do it. Like, we still have to have this discussion. So if I want to know where the year is going to end in 2024, I should know what the earnings are going to be on the S&P for 2025 to get the forward PE numbers. So like that. So right off the bat, I need to I don't even have 2023 numbers yet. Right. And now I have to know what 2025 numbers are going to look like. Okay. Good luck. But okay, there's a trend, there's a range. Fine. And then you're adding on that other complication of, well, what are people willing to pay for those earnings, i.e. the multiple to get there? So yeah, like of course it's hard, Derek, right? And which is kind of why like we only do it in jest and we don't make our investment decisions based on the accuracy for our ability to project things like 2025 corporate earnings.
Yeah. I mean, I'll give you another example. And I found this picture from Barron's, and it's not the current Barron's. It's the one in December of 2022, and it was the year end where the analysts are making their year end 2023 predictions and targets. So that's essentially right now, like what's the market going to be at the end of next week? Well, what's fascinating is, I'll give you two examples. Ed Yardeni Research, had 2023 S&P 500 EPS. His estimate was 225. Gaurav Malik from State Street Global Advisors also had 225. Now, you might say that's not really interesting. But what is interesting is Yardeni's year-end target for this year was 4,800. Malik's target was 4,000. So it's not a forward PE because I don't have their estimates for 24, which is what the forward PE would be right now. But really, the only difference is what the trailing PE was going to be. I mean, that's it. These gentlemen had each the exact same EPS targets, but 800 points difference in their year-end targets. So it's all multiple.
I'm looking at kind of the difference between their two predictions, right? And there's two ones that are pretty stark to me. The first one is the Fed funds rate, right? The one with the lower Fed funds rate by only 50 bips, gave a higher number, like, okay, higher multiple with lower Fed funds rate. That's not surprising. But the big number is the growth, right? The real GDP growth, right? The one who had the lower projection said only 0.4%. The other one said 2.0%. So I think there's one of those things that gives you an idea of what drives a multiple when it comes to these numbers. It's growth helps, right? Growth creates the higher expectations. You're willing to pay more for growth, and that's why I think that one of the reasons that the Yardeni projection of 4,800 was so much higher than the Malik one at 4,000, right? Like, growth matters, right? Growth is good for markets, helps with the earnings, even though they have the same earnings number, which is very interesting, right? It's kind of like the rate of momentum, right? Which one had the momentum?
The other thing I'll say is, and we talk to the people, different people at State Street all the time, is I know that I can't recall it right now, but analysts revise their estimates as new information comes in. So it's kind of like, imagine if you and I, instead of being in the investment world, we were on CBS Football Sunday or Fox Football, the pregame show, and you're like, oh, I think this team's going to win by this much. And then new information comes in, you find out the quarterback is out. You're like, well, I have new information. I have to change my outlook now, like that happens all the time. I don't know. I mean, I think it's a good exercise, but it's a little silly to look at all these predictions, even though we're going to do it next week. It's really, and don't you think too that when you have a bad year, your predictions are much more bearish than when you have a good year. Like, think about at the end of 2021.
Yeah, recency.
Bullish for 2022. Bias. Yeah, absolutely.
Yeah, recency bias, of course. The
other thing that, so Sam Rowe on X is he puts out some interesting stuff. He also had a distribution of S&P 500 annual total returns 1957 to 2023. You and I mentioned this a couple weeks ago, that like very few times does the market actually get the average return that's been the average over a long period of time. And Jay, what his chart says is the market is most often up 15 to 30%. Second most often is 0 to 15%. That's interesting to me. Like, market's up a lot of times.
I mean, it's one of those things, we talk about it all the time, that markets, tend to go up, right? And in this chart here with I guess it's 66 years, 67 years of history, 23 times, which turns out to be about 35%. 35% of the time, the market is up between 15 to 30% in the calendar year. So one out of 3 times, it's going to be up what we just saw. I mean, that's, by the way, then 10 more times, it's up, 30 to 45. So, like, if you were to think about that, Derek, that means half the time in this study, right? I just said 66 times, 33 times, the market is up 15% or more. It's one of those things that, like, you want to position yourself to capture the things that, are generally the trend, right? The next follow-up question is, well, how about, just, being down? The numbers on this period are, 15 times out of 66 was the S&P negative, right? So 15 divided by 66 is about a quarter of the time the market is down. So 3/4 of the time the market is up. Like, that's a good thing. It's why we like to stay invested. Like, that is a trend. I don't say it's easy, but I'm just saying, it's like, gosh, lean towards the thing that happens more often than not, especially when it comes to investing. It's one of those things that I like to say is just, it's over time, the markets tend to go up, and you're going to participate in that. And like if I told you half the time the market's up 15% or more, you'd be like, well, of course I always want to have exposure to the market then, right? I always want to have some level of exposure. Now, those really bad years, this is why we hedge for people that don't have, a longer time period, right? I had a client of ours who's going to probably retire in the next 2 years, and he asked questions about being more aggressive. And I was like, look, if you had 10 more years to go before retirement, totally behind that idea. But you got 2. Like, I don't know what's going to happen in the next 2 years. I feel better about what's going to happen over the next 10 versus the next 2, which is strange. Like, normally you add time, predictability is less. But I think when it comes to things like the market, history has told us that give it more time, you're going to be up more often than not. And, time is actually your friend. So, yeah, I think this is a great data point. And just a reminder again to everybody that, like, look, while nobody thought we'd have a plus 20% year this year, it happened. And guess what? It happens more often than it doesn't.
You look at the audience can't see this, but 3 times in 66 years, the market was minus 15% to minus 30%. One time, 2008, minus 30 to minus 45%. You brought up hedging. I mean, this is sort of like, imagine if you're hedged and you can sort of X out both of those column stacks. If you kept an annual loss to somewhere around 10% and you don't take those really, really bad years, then it gets even more appealing, is my point of being, you buy, but you hedge. We don't know what the market's going to do, but that's the idea. You take away those really, really big numbers. And then half the time, as you said, since 1957, the market's up 15% or more. That's pretty significant, Jay.
Pretty significant. Yet I don't think we're going to have a lot of people predicting 15% or more in our predictions when we do them next week, which now I'm like, maybe I want my predictions back.
Well, Ed Yardini, he said it's going to 6,000 by the end of 2025. So what would that be based upon the close today? That's 26% over the next 2 years is what Yardini is saying.
Okay, so that feels like the numbers we're talking about here support that.
Yeah. Do you remember I didn't pull it up for this show, but at the end of the decade, so there was some data. There was somebody who showed a chart, and it was basically saying when the previous 20 years annual return was X, and then they showed the scatter plot. And the analysts at the time were only predicting whatever they were predicting over the next 10 years. And the guy showed, like, if that actually came true, it would be such an outlier to the downside, meaning normally you get much better returns after you have a 20-year period. Remember, 20-year period prior to start of 2020 was you had 2008 in there, you had 9/11, you had the tech crash, so I'll try and find it again, Jay, and we can maybe talk about it more. I don't know if you remember that. It was the scatter plot.
Oh, yeah, I totally remember it, right? And it kind of predicts based on, the average return over the next 10 years based on what has happened. So, yeah, totally remember it. It was interesting data. I would say, feel like this year feels like an outlier from the last time we saw that data, right?
Yeah.
Like it was coming in lower and lower. So we'll see, like all data, it's one data point.
I want to talk about Christmas movies in our recommendations, and maybe you have a different one. But before that, I want to bring up something. I've cited him a lot. What is his name? Why can't I remember his name? He has the 12-year forward graph, Jay.
It's not Schiller. It's yes, I know we've talked about him before. Now I'm drawing a blank as well.
I will find it. But I'll start with just what he was showing. You remember you might have remembered the dot plots came out, and for anyone who doesn't know what the dot plots are, John Hussman, Jay, is the gentleman.
It was Hussman. Very good.
Yeah. So Hussman, the dot plots came out, and basically the dot plots say they asked the Fed members, what do you think inflation is going to be next year? What do you think the end of year Fed funds rate is going to be, and all this? And people made a big deal about it because they said, "Ooh, look at those dot plots." look at what they think the Fed funds rate is going to be and the median of the dot plots. Now, I will say that the dot plots, I think, started with the Bernanke Fed, the era of new transparency, and they've continued since. And Hussman had a tweet or on X, I guess you can say, basically saying the the correlation between what the Fed dot plots are and then 1 year later, whatever the metrics wind up being is like 0.9%, meaning like they're worthless. They're worthless. And written articles about this, like their predictions are awful. In fact, Bullard, who has since retired from the Fed, at one point didn't put his dot in because he said, we're awful at this. Like, what are we doing here? So anyway, I thought I'd bring that up. Well, and he actually took the time to run the correlation. So
it moved the market this month, right? The dot plot showed a drop in rates and the market ate it up.
It did, but people shouldn't look at those dot plots. All you need to do is go, and it's on the Fed site, go look at like 2014, what they thought the Fed funds rate was going to be in 2015 and how wrong they really were. They were like, oh, it's going to be 3.5%, 4%. No, it was next to zero. It was almost zero. So
wow. Yeah. Well,
that's how you do it. All right. So do we have anything else on the agenda here? I guess we're done. Are we really done?
I mean, we usually touch base on volatility, but I think we're good. Like same story as last week, continues to show low volatility for a little longer, which I'm not surprised based on this week, even with that weirdness on Wednesday that, the zero DTEs got blamed for. Yeah. VIX still has a 13 handle. VVIX a little elevated.
It did. It's interesting though. It didn't spike.
No, it did not.
It didn't do anything on Wednesday.
Like if it was options based, it would have spiked the VIX. Not people, whoever wrote that, you would have seen it. And the whole point of zero DTE, that's what the VIX reflects, options. So, all right, sorry. Now I'm back. Now I don't like it. Lazy, I don't like it.
I know you don't like it. The VIX and the VVIX, the only thing I'll say about it is we run a quantitative strategy and we look at 19 different, also called volatility or option-based triggers. And so one of the ones we've been watching is we look for this compression and then uncompression, I'll call it, let's say the VIX and the VVIX. And it's really, you're looking at standard deviations and things like that. And it was like just flatlined. It was nothing. And we have seen that start to jump up a little bit. And the reason I bring that up, and Jay, you can talk about this a little bit briefly, is sometimes when it goes from being, really compressed to starts to unwind, it could be forecasting maybe a change in the volatility. But the other things we watch really aren't pointing to that yet. I don't know if you want to comment on that real quick, and then we can move to some of our
we're not there yet. It's always like you have a trigger and there's a level for the trigger, so don't jump the trigger. But if that trigger was to kind of come through, it might signal maybe a slowdown on this, pretty quick, rise in price in the market, right? So the quick move up. So maybe it'll take a little breather, maybe a little retracement, but so far, it hasn't happened yet, but we're watching it to approach. Because even when you look like, a day like today, like this is Friday, before Christmas, like, the market was up a little bit. Like, that's okay. That could continue to kind of trend sideways. There's nothing saying that, that's going to stop yet. But, if that trigger gets there, then maybe it shows a slowdown or a slight turn. But there's no red lights going off at this point for that one way of assessing what's coming.
Agreed. All right. Let's do some. Can we talk about Christmas movies?
I love Christmas movies.
All right. Well, I got to throw Die Hard in there.
No, even Bruce Willis said it's not. Nope. I watched his interview. He was on stage. Somebody asked him, and he said, "For the last and final time, I will tell you, Die Hard is not a Christmas movie."
I completely disagree. It is a Christmas movie.
Bruce Willis?
I'm sorry.
That's right. I'm going to read your book and tell you that you're wrong. Although there's nothing wrong in the broken pie chart. No, it's wonderful. Yeah. Listen, you want to watch an action movie that takes place during Christmas? Great. It's an action movie.
I will say that I remember when Die Hard came out, I think it was 1988. It was the summer. So you think about that. It gets released in the summer, but it happens to take place around Christmas. I remember seeing it in the movies.
I saw the movie theater too. I think that underscores my point. Not a Christmas movie.
All right. Castaway, not a Christmas movie either. Although it does have the Christmas scene.
Not a Christmas movie.
All right.
No. That's this is a whole segment. Movies that take place during Christmas that are not a Christmas movie.
All right. Well, you have any recommendations?
Christmas Vacation's a staple for me. You know what's a recent ad for me is Four Christmases, if you haven't watched that. Reese Witherspoon and Vince Vaughn. So we have our core 5 that we watch every year. That one's made it into the number 6 slot. It's hilarious. If you haven't seen Four Christmases.
I have. Yeah, that's a pretty funny one where I think the premise was they tell their families they cannot go to their respective houses, and then they go to Fiji or something like that for Christmas.
Well, they were going to go, right? And then their plane gets canceled and they get caught on the news standing at the ticket line going to Fiji, right? And then they have to go to each one of their parents' Christmas. Yes. Very funny. Very funny.
All right. What about Love Actually?
You got a fave? That one's not on my list. I know that is definitely a Christmas movie though, but that one doesn't make my list. My must-haves.
All right. Any other recommendations? I can't watch Elf. Can I tell you why I can't watch Elf? You might remember when I was traveling every single week back in the TD Ameritrade days, they used to show a movie on the plane. This is a while ago. And every time they would say, we have a special treat for everybody. We're going to show the movie Elf. It was on every damn flight, Jay. And, this is sort of before you had the iPods and so I watched it a bunch of times. I can't watch it anymore. I can't do it.
All right. Elf's on my list. Of course, Christmas Story. Home Alone is on there. And then one that I like to get in, but the rest of the family doesn't like is Scrooged. So that one in the movie theaters as well. Some great one-liners in there in Scrooged, if you haven't seen it. Bill Murray movie.
It's a Wonderful Life is sort of a business movie because it deals with a run on the bank.
There you go. Run on the bank.
See,
we're going to end with a run on a bank.
Well, I guess we got to end somewhere and might as well be there. All right, Jay. I think we'll call it good for this this holiday edition. Or this might be out a little early too, because the person who produces this, we never edit it, but it is sort of our levels are evened out, and he's, I think, going to do it a little bit early. So it might be out sooner than the normal Sunday, but we'll see. All right, Jay, that's it. We'll be back next week with predictions, and we'll see how we did in 2023. By the way, I would let the audience know you are outdoing my the predictions from 23 so far. Mine, not so good. Yours, much better. So there you go, Jay. All right, everyone. Hope you had a good holiday. Talk to you soon. See ya.